Welcome in, guys. Excited about this chat today. I think it's super relevant what's happening because of interest rates, kicking everybody's butt, maybe preventing people from investing in real estate. So we're going to go into that. So today, kind of the flow is we're going to go through like the challenges it's creating right now in investing because of interest rates. We're going to talk about how we've kind of figured out how to work around it and strategies and ways we've managed it through creative financing. And the last thing is we're going to talk about like second to last thing is we're going to talk about different ways that other investors can take advantage of it. Whether that's somebody who wants to be really active, somebody who wants to be completely passive, or maybe they want to buy turnkey, but other options so they can get in and take advantage of these interest rates. And then the last thing is we'll have some time at the end to talk about some of like the frequently asked questions. You guys can ask questions, but like dive a little bit deeper into almost like a mini workshop of like creative finance, Subto, like what are the questions you guys have? And I'm gonna go over a lot of the common questions I get. So to start off, the interest rates data. So I pulled up this chart here, shows us the historic data of interest rates, and as we know how much it's changed, right? So just looking at this big dip from all the way down here, sub 2s, 3%, all the way up in the last probably 6 months to a year, last couple of years, we've got this delta right here is what we're faced with, right? And I was kind of doing the math, and I wanted to show you guys the math on that. So years ago, maybe even short as like 12 to 18 months ago, we could still borrow around 4% going with that type of loan product, right? That same loan product now is not at least 9, maybe even 10%. So that's a delta of like 5%, right? So doing the math on that, so 0.05, let's talk about a house here in Sheridan maybe that you're gonna get a $300,000 loan on, right? You could maybe find a single family house or something, and maybe you're buying it for more than 300, but let's say the financing is 300. So 0.05 times 300,000. Okay, so that is $15,000 a year now that you're losing to interest. That was $15,000 of cash flow that you would have had, and now you don't have because you're borrowing at 9% instead of 4%, right? So think about what that means in your ROI. So let's say that same house for $300,000, your loan, you put 20% down. So 20% of 300 is 60K. So let's say, because what I want to do is I want to say, because 15,000 is relative to everyone, right? 15,000 might be, if that's the return you're getting. Again, it all depends on how much money you're putting in. Like, what are you putting in to make 15,000? So what I said is the down payment on that house, 20% of that $300,000 house is 60K. So we'll do divided by, so this is the cash flow that we lost divided by 60,000. So that's 25%. So that is a cash on cash number, right? So literally your cash on cash has dropped 25%. You think about the stock market where people are happy. If you're making 10% year over year, a 10% cash on cash return, you're pretty happy, right? Like literally what interest rates have done to us is they've dropped our cash on cash return 25% just because of interest. So, but what if we could continue? So that's where we're at right now. That's where a lot of investors are at, that they've lost 25% of their cash on cash return because of interest rates. But what if we could go back and we could still keep buying and make numbers work in that scenario? That's what I want to show you guys how we're able to do that. So really the big answer is subject to, right? So I want to talk about our Subto pipeline. So we started working Subto deals about 3 years ago is when I did my first Subto deal. It was actually over in Gillette. Took over a lady's loan situation where she needed to sell. She didn't have a ton of equity, but her loan amount was like 120,000. But the house was only probably worth, when she was trying to sell it, maybe 130 to 140. So by the time she paid an agent and maybe made some repairs, there really wasn't much incentive for her to sell it on the market. So I'm like, well, your house you don't have a whole lot of, she wasn't upside down, but she didn't have a whole lot of equity, right? So it's like, why don't you just sell me the house, let me take over that loan? Because it's like, that loan is super valuable because it was like 2.75%. Her payment was $575 a month on this little 3-bedroom, 1-bath townhouse in Gillette, where my payment is, again, $575 a month. I'm like, well, I can turn around and rent that thing for $1,200. So I was like, this is a great deal for me. But again, she didn't want to be a landlord, and she also didn't have equity. So it was a great deal. So that was the first one we ever put together. In the last year, we've put together over 10 of these deals, these Subto deals, where we're able to find sellers who are otherwise might not be able to sell their house by traditional means, but they have this mortgage in place that's again, maybe they refinanced a couple years ago when the rates were good, which a lot of people did, right? A lot of people were like, hey, interest rates are low, let's go refi, cash out, or do something, go take advantage of this. But now they have to sell. So that's kind of the people we're marketing to. So that's kind of how we've been able to take advantage of, well, it's been a way that we've been able to like continue to buy and make deals work. Make that still work when we lost 25% of our cash on cash, we're still making it work. So now let's kind of talk about the different ways. So like who can buy these deals, right? So we're finding them, but a big part of this presentation is how can I get other people involved so where they can take advantage of these, right? So there's kind of 3 different types of people, right? These could be fix and flippers, long-term buy and hold investors, maybe people doing the BRRRR strategy. This could be people that are working with real estate agents and they're trying to find their next rental property, but they can't make numbers work, right? This could be a house hacker, somebody who wants to actually get into a house and rent out bedrooms and do it like people in house hacking for a while, but now they're trying to house hack and they can't make the numbers work. Or maybe they just can't get approved for a loan at 8 or 9%, right? So the other big group that I've been working with a lot is a lot of syndications and funds. And these people have capital that they've aggregated and put together and want to put into real estate. But right now they're struggling to where they're going to put this money into, right? How are they going to, they just lost 25% of their return to their limited partners. Like how are they going to continue to buy new assets and make it work? So we're working with those groups and saying, hey, well, you know what, you can still do it. We can still buy these properties, but you got to do subject to. And the last thing is turnkey buyers, right? So this is one of my favorites, and it's where people who want to get into real estate, want to buy a rental property, and want to get all the advantages of being a real estate investor and owning property. I mean, we always talk about the big 4. It's always appreciation you get, the depreciation and the tax benefits, the mortgage pay down, and the cash flow. But usually now you're not getting cash flow because of interest rates. But when you do the subject to, you actually get all 4 again. So what we're doing is we're teeing some of these properties up where we find them subject to. We'll actually pay and use our contractors to make the repairs to get it ready, and then we'll place a tenant. That might be a short-term tenant or a long-term tenant, and then we'll get that all packaged up and just go sell it to somebody. And all they got to do is come up with a down payment. So I'm going to show you how kind of some of these work. So for operators, right? So this was that first group. This is somebody who wants to go fix and flip, buy a rental property, but they want to be more active. They want to manage it themselves. They maybe want to manage the contractors themselves. So this is a big spreadsheet of all of our inventory, which is a little tough to see, but I want to show you guys a couple of the deals that we've done. We're going to keep coming back to this, but this is a good snapshot of the ones that are crossed out real quick are ones that we funded in the last couple of months. The rest of these are deals that we're currently either we're keeping or we're selling subject to somebody else. So I'm going to dive into kind of each case. So this first one, first couple are this 3942 farthing. So I want to show you 3942 farthing is right here. So this house, we assumed, this was actually listed on the market at like $740,000 in Cheyenne. Really like beautiful house, gorgeous house. But these guys couldn't sell it because houses weren't moving in Cheyenne at that price point. But they had a mortgage at they actually were around 5%. But I looked at their payment was roughly $3,300 a month. And I'm like, for that house, $3,300, that's a pretty great deal. There's gotta be people out there who would love to take over that property and actually live there. Like personally, if I was gonna live in Cheyenne, I'd love to. That was a lot of bang for your buck, especially for people today that wanna go buy a really nice house. And this is the higher end. I don't have a bunch of high-end ones on here. But for a high-end property, this might be a house hack, or this might be just somebody who wants it for their family. Or in the case where we sold it, it was a contractor who had a great business, but not all the W-2 income. So he wasn't able to get approved for loans. And even if he was, he probably didn't want to go pay $4,500, $5,000 a month to borrow at current rates. So what made that deal work was I was able to sell it to him, and you can kind of see the numbers as you work through here. So, okay, so he ended up putting $70,000 down. He assumed a loan of $498,000. He also got equity. This is the other beautiful part is he put $70K down, and he ended up purchasing this around $650,000 when the house was, I mean, I have no doubt this house when interest rates come back down is going to be back to being worth $740,000. So anyway, he bought that. This was his PITI payment was $3,287. And anyway, I actually ran the numbers here for a while. Like that could have been a long-term Airbnb. And I think we could have got $4,500 a month Airbnb, bought some furniture, and still got a good return. But that's one example of that one. The other operating one I wanted to share was a deal in Sheridan actually. So this one is at 472 East 5th. That was a cool one. JR and I talked about for a while. So we've purchased this one subject to. We were able to negotiate with a seller to where we actually he's got 2 different loans. So again, I'll walk you through this one. So the financing assumed is $146,000 on that property. He has a first lien and a second lien. He actually had a mortgage, and then he had a line of credit. And so that is what he owes on it. His payment altogether was $13.99, so that's his monthly payment, and this was the full purchase price of $220,000. So the way we're selling this deal is if we have an investor who wants to either buy a rental property, because this is a 3-bed, 1-bath. I mean, it needs work and it's got some foundation issues. And we're still trying to figure out if they really need to be addressed or if the house is just settled and it's where it's at, right? But the thing is, you're pretty low risk, right? You're putting $30,000 down on this property. Sorry, this one is a $20,000, yeah. I was saying $10,000 if you furnished it and went Airbnb, but if you just wanted to buy this and do a little bit of sweat equity and go in there, do some flooring, do some paint, really just give it some cosmetic updates, you could get in for $20,000. You're gonna take over the financing of 146. Sorry, this one is a little bit different. This is what I call a hybrid. So you see how we put Subto hybrid? I should explain that really quick. So a lot of these deals, in this situation, he only owes 146 on his house. It's worth 220. So what we did is we do basically a second note with the seller on their equity, right? So again, he owes the bank 146. What we did, we basically said, what's the difference between what he owes at 220 and the 146? And sometimes it'll be like, we won't even make payments on it. We'll just have a big balloon payment when we go to refinance or sell it. Or sometimes we will make a monthly payment on that equity. It just depends on how we negotiate the deal. It really depends on what the seller needs. But if they don't need all the cash, we'll just have no payments. And in this guy's situation, we're not making any payments on that equity. We just agreed that after 5 years, we have a balloon payment that we will not only pay off his loan, but he'll be able to get the rest of his equity out. And he was happy with that. So in this situation, you're able to take over a property with 20 grand down. It needs some work. It's a great one for somebody who wants to be a weekend warrior and kind of fix it up. You could also hire contractors for it, but I think it's one of those ones where you would just want to do some sweat equity. And then again, you take over a payment of basically $1,400 a month. You're gonna have a 3-bed, 1-bath. And the other thing is it has a really nice shop, and it's right on like 5th and Sheridan Avenue, like literally right at the corner where they just put that new light in. So, and it's got like a big 3-car. We're thinking about using it as our shop if we keep it, but anyway, so those are kind of some cool examples of deals that we're getting. And I look at it as, hey, we negotiate a lot of these deals. Yes, I could keep this for my portfolio, but at this stage in my career, I would like, in our business, we'd rather sell these off and let somebody else take advantage of the great terms, you know? So that's the kind of active one. Any questions so far? So that's more, again, we're talking about the operators, the fix and flippers, okay? So let's talk about the funds now, like the ones I mentioned, selling to these different funds. So here's one we just got, we're closing on soon. We actually just walked this today in Casper. So this is a triplex in Casper and I'll go kind of show you the numbers, but basically it's probably easy to show you on the spreadsheet to go back to it. So this one is right here. So the 3-bedroom, where are we at here? Okay, so Gregersen, this is another hybrid, just to show you the numbers. So the financing assumed on this one is $200,000. That $200,000 is made up of a hybrid loan, which is, again, using easy numbers, it's roughly $150,000 that the seller owes to their bank. So we're assuming those terms subject to, and then for the additional $50,000 of equity, we're making her a payment on her equity, but it's only like $400. The total payment all together on this one is, going down to Gregersen, is $1,400 a month. So you're buying a triplex, you're taking over a payment of $1,400 a month, and your total purchase price is this loan amount you're assuming plus the down. So you're buying it for $245,000. So again, your purchase plus your down, but you're only putting $45,000 down. And the big thing I like, and I actually forgot to bring this up on the other one, these last 2 columns are the big ones, right? Like, what is your ROI cash on cash, right? So for this is long-term. I also ran a couple of these deals and analyzed them if you wanted to do short-term, medium-term, or short-term and actually pay for the furniture, which I think, as you'll always see, you're typically adding 10 to 20% ROI if you go that route. And I always like to underwrite them to where they work as a long-term, but this is the definitely more lucrative strategy, is to go medium-term and furnish them. But to kind of give you the numbers on this one and why like funds and syndications are excited about this is they're looking at, okay, so I've taken over a payment of $1,400, my taxes, my insurance, all these expenses all added together. Basically, it's outputting a cash flow each month. And this has got all your short-term, your repairs, your utilities, all your expenses all baked into it. It's spitting out $775 a month in cash flow. So if you go divide this, or basically multiply by 12 to get the total income per year, divided by the $45,000 down payment, that gives you this 20.66 return on cash, right? ROI, cash on cash. And this is why it's working, right? Kind of go back to the beginning of the presentation. We talked about, man, we lost that 25% of cash on cash. Well, we're now getting it back because we're taking on these terms and we're getting that much cash flow, and then that's our down payment. So questions any on that so far? So what was the other one I wanted to show? Another case study. Rimrock, here's another good example in Billings, Montana. So this is a duplex where basically the terms that we've negotiated on this is okay, here's Rimrock. So this is the owner. This one was actually an owner finance. To explain another strategy, she owned it free and clear. So what I just negotiated is say, hey, if I make payments to you each month in the amount of $1,650, and I could purchase it for, basically it was $335 plus the $75K down. So it's like I think that's $410,000. So basically let me seller finance this. I mean, the simple part about this to look at it is I'm taking over the property with a payment of hold on, let me find it more. Okay, so taking over payment of $1,650 and the down payment is $75,000. And then when you kind of look at, so if you kind of run through the numbers and you run through the expenses on all this one, your taxes, your insurance, all the different stuff, you're still outputting $1,800 a month in cash flow. Again, it's a great duplex. It's in a great area of Billings. So if you look at your cash on cash, again, dividing it by I take it back. It wasn't 75. It was 60,000 down. That seemed high. It was 15,000 if you wanted to go the route of the short term and actually furnish it. But if you just went and put 60,000 down, you're gonna get this return of $1,800 a month. That's a 20% cash on cash return. So again, the important thing to remember is that's your cash on cash. You're still paying down that mortgage every month. You're still getting depreciation because you own the property, and you're still getting appreciation, right, as the value goes back up. And this one, you're actually buying at a discount. That was one other thing. Again, and I could share, I'm happy to share all these deals with anybody, but this is like kind of a catch-all. You can do all your underwriting, have everything you need. But the other big part is the forced equity, right? We're actually buying this house in particular, and all of them, this is how much equity you're buying. When I say forced equity, right, you're buying at a discount, or we have fixed them up and created some forced equity for you. So on this one on Rimrock, because of what it's worth and what we're buying it at, it's got $40,000 of forced equity. So you're not only, I mean, you're winning in so many different ways, right? Again, cash flow, appreciation, depreciation, write-offs, and you're building in equity. Cool, so that is, now let me do the third one, is the turnkey, right? So a couple turnkey options is, here's an example, this one in Casper. And we've actually, really wanted to hit on this one because we've actually sold a couple of these in the last couple of months. So the ones that are crossed out, the one in Douglas and on row 3 in Gillette, those were properties that we assumed their mortgages. These were very similar to the first one I told you about, where the seller, and I'm seeing just a lot of these, JR, were not as much in Sheridan, but other kind of smaller towns and other places, and especially Gillette and Casper more so, where people, their house, okay, so again, I'll give you this example. This guy in Douglas, his house is worth $185. He's trying to sell it, but it needed some repairs, which I've been able to go in and do with our crew, but he couldn't really afford to go do all those. His loan amount was $144. So by the time he went and made repairs, paid an agent, there still wasn't a ton of equity. And the fact that nothing's really moving on the market right now in Douglas in November. And again, I negotiated this several months ago, but it was after the summer was ending and this guy couldn't really sell, right? So it was a great thing for us is we actually gave him, I can't remember, we gave him maybe $5,000, $10,000 down. So we were able to actually give him money to walk away. But then what we were able to take over is a payment of $826 a month. I was able to turn around and rent this thing for $1,400 a month. And so we're making the delta, right? So I kind of did the cash on cash analysis based on that payment, taxes, insurance. Well, the beauty of that one is taxes, insurance, were escrowed. And then assuming the repairs, I put in some kind of contingency for repairs. And anyway, that long-term one is a 12% cash on cash return. And that's just a long-term passive. It was actually a little bit, this one, because here, let me talk about the turnkey piece, right? So the turnkey piece was, we actually sold this to a guy out of state. He's actually from Chicago, met him. He was interested in one of our other properties and bought them. I'm like, hey, why don't you buy one of these cash flowing deals? He's like, well, send me the numbers. And when I kind of walked him through the fact that he only had to put $40,000 down and it was gonna spit out $400 a month in cash flow. And that was after I leased it. So what I did, because I'm not a broker, I can't legally manage other people's property. what we did is I said, hey, I can get this thing leased. I'll be your tenant and I'll sublease it. So I basically said, hey, let me on this property. For example, I rented it, I think for $1,550 or something, over $1,500 a month. I rented it, and then I subleased it, right? So he rented it to me, and then I subleased it. That way he's got it cash flowing. So that's the one way we've been doing it, truly turnkey, to where that guy could be in Chicago. He just wired the title company $40,000. He closed it, deed transferred to his name. He's now the owner. I'm leasing it from him. He's got a tenant. So he's cash flowing day one. He didn't have to go get a loan. He didn't have to find a property manager. He didn't have to do any rehab work. He's able to just literally walk in day one and start cash flowing. That's the beauty of turnkey, right? There was one other point I was gonna make on that. Oh, and some of these too, what we found is, so the way we'll do turnkey, again, because I'm not a broker, is we'll do the sublease thing. The other way we're doing it is we'll go short term. So there's no rules against, you can be a co-host, right? On Airbnb and other places, you can help co-host people's properties and help manage the short-term side of it. So we do several short terms, and across Wyoming, we've got our first one in Billings now. So what we'll do is we'll co-host them for people, and we'll manage the cleaners, we'll manage the repairs, we'll manage all the bookings and all that for people, and then we'll just have a whatever standard kind of fee for that. And that's why I kind of wanted to show this column, is that shows you your returns if you do some of that. But anyway, really cool strategy, especially, I don't know, what I'm really bullish on is doing more of these short-term or medium-term rentals where you actually pay to furnish it, because we're just finding a lot of demand from companies that are still moving people out here, that are working on wind turbines, or they're here in a refinery or doing some sort of work, and they want furnished housing for their workers. And those are big checks. Like, all of a sudden your rent will double or triple sometimes with those clients, especially when you do subject to, it just really compounds your return. So anyway, wanted to go through all those ones. The last one I wanted to talk about was a completely passive option. So all those three, turnkey is pretty passive, but you're still the owner. You get all the depreciation. At the end of the day, you're the one on the deed, right? And like I said, in that one situation where the guy from Chicago, ultimately I set it up to where if he ever wanted to get rid of me as a tenant, we did a month-to-month lease, and then I had a month-to-month lease with my subleasor, I guess you would say, right? But I told him, hey, if at any point you don't want to do this, or you want to get a different property manager, you're able to. He can become active at any point, right? But here is, I'm talking about, the last one is being more passive. So that's where you can invest in some of our deals that are subject to, that we're getting good returns on, but you just become the lender typically. You just become in second position. So I put this note here. We typically always collateralize these with a second lien position behind the existing Subto mortgage, right? I'll talk about two ways we do it. The second one is the revive method. I'm gonna explain in a second. That's where we're actually fixing and flipping properties using Subto. Really cool one we just did in Cody I want to tell you about. But before I get to that, this one is a little bit more complicated, but I just wanted to kind of tease it and highlight it. And it's for the sellers so for example, I talked to a seller the other day who has a house that's worth, the house is worth like $350 on the market, right? A loan amount is only about $100,000, but he needs $100,000 to go maybe buy his next house, or maybe he needs to pay some credit card bills. So anyway, his loan amount is $100K. He needs $100K, so that's only $200K. Add that up here, it's a $200, right? But the house is worth $350. What we're able to do is we're able to negotiate. We'll say, hey, I can get you $100K at closing, and that solves your problem. If you sell the house at a discount to me, so maybe instead of $350, sell it to me at $300, but I get you your $100,000, and then I say I'll get you that. So again, we're at $200, and then we're agreeing to sell it at $300. That last $100K we'll just pay in 5 years in a form of a balloon, right? Or we'll figure whatever terms we want, but ultimately we'll say, hey, I'm gonna give you your $100,000 now. You're gonna leave your current mortgage in place, and then you're gonna sell it a little bit of a discount. So the way the passive investor comes in is I'm thinking, myself as an investor, I could go invest our capital and money into that, but what I'd rather do is go find a passive investor who comes in with that $100K that we need, right? So they give him $100K, get him out, but then that investor is protected, right? Because there's $100K first lien subject to, and then he's $100K, but he's only at $200K total. House is worth $350. So he's got all that cushion, right? And so what we'll do is we could typically pay 10 to 12% on these second liens, and they're still, I think, they're secured, but I think they're still low risk because of it's the loan to value, right? At that, you could run the numbers on that particular, either way, it's easy. It'd be 66%, right? The total financed amount is $200,000. And say the house was worth $300, it's $100K of equity. So it's still at a 66% loan to value. If we had to fire sell that at any point, he could still get his money back, right? So that's one strategy. We're working with passive investors and also working to help home sellers who are in a situation where they really want to sell their house. They maybe can't sell it on the open market, but they need 100,000. Anyway, it's one way we've been solving that, right? So anyway, that's a little bit more complicated one, but it's a great opportunity. And I'm just seeing there's a lot of people in that bucket that have good loan terms, but they need a big chunk back, right? And that's the way we structure those. Second one, this is probably my favorite one lately, and we've been doing a bunch more of these, and it's we call it the revive method. And this one is, let me show you it. Okay, so it's probably easier to just give you guys a scenario for it, and I'll actually just explain one in Cody. So this house in Cody, lady's selling her house, and it's a big rehab. So this is geared toward houses that need a significant rehab, and it's like $100,000 to $200,000 rehab. But the way I look at it with them is like, hey, if I can assume your mortgage, I'll go put in the $100K to fix it, and then we'll sell it on the back end and we'll do a profit share. So I did with this lady in Cody is she owed, we set the price of $200,000 is what I basically bought it for. And that was roughly her mortgage amount was $200,000, right? So $200,000 is our baseline. I told her that, hey, this is gonna cost me $160,000 to go fix it all up to sell it, right? So there, at that point, we were at 200 plus 160, so we're at 360, right? But this house, I'm like, if we fix it up in Cody, this house is gonna sell for like $450,000 to $500,000. So we ended up selling it for $510,000, but I'll just use it, $500,000 is an easier number. So sold for 500, 360 is what we were all in for. And what we structured was, hey, we can split the profits 50-50 once we sell it, right? So she was able to get 50% of that 360 minus 500. So she got another 80K out of it. And we also made our 80K, and it was a really cool deal. And the way we set these ones up is we close on them. We didn't do it in this one because she had a complicated probate process. But the way we're doing these now, we actually got one in Cheyenne right now, and we have another one. We have 2 more in Billings that we're doing like this. But what I do is when we close on the front end, I actually transfer the deed to us because I'm like, if I'm gonna go put 100K rehab in, I'm gonna be protected, right? And we're not gonna do a mortgage. So what we do is I actually deed changes to me, and then what I do is I issue her a promissory note and a filed mortgage showing, hey, this, when we sell this is agreed upon profit share and how it's calculated, right? So that, and then what I really like is bringing in, the reason I brought it up at this point of the presentation is what I'll also do is like, okay, so I could use my company's capital to go pay for that $160,000 rehab, or we could go with a passive investor who fronts that money and we pay 10 to 12% for them to borrow that. But again, we're so well protected because again, the same situation, the $200,000 loan that we assumed, plus the 160, we're only at 360 in a house that's gonna sell for 500. So that investor is still very well protected based on the loan to value, right? So it's a good opportunity for them to make a good return on us. It also helps us to where we can do more deals now, because now I can do 3 or 4 of these, maybe 5 or 6, but if I'm putting 150,000 out each time, that adds up, right? So we love bringing in a passive investor who can participate in that deal and still have a lot of cushion in it. So this rehab, and honestly, it's a true win-win because again, this lady in Cody, she wasn't about to go drop 160,000, but at the same time, her house couldn't sell, wouldn't even get financing, right? So it's been a really good solution for these bigger fix and flips. But that's okay. So that was the last strategy. So that was the 4 big strategies. So the last thing I was just gonna open up to is kind of talk about, kind of segue into the like logistical, like, well, how does subject to work? What happens on the due on sale, and kind of some frequently asked questions on these, because those are the mechanics, those are where people have a lot of questions. So the first one is subject to, right? And like whether you're suing the loan or you're taking subject to, and what if the lender decides to call the due on sale clause? So have you heard, I'm sure JR's heard about subject to, or the due on sale. Have you heard about due on sale? So due on sale is the clause where if the deed is, so in these situations where we take the loan subject to, the deed is signed. So, okay, so think about it this conceptually. When a property sells, or either way, when there's a property, you have a deed that says who the owner is, and you have a mortgage. The mortgage just says who is owed money, right? When we buy these properties, the deed changes to us. Mortgage stays in place and it stays with the seller, stays in their name, right? And that's a big conversation we have to have with sellers. And that's why these deals are not easy to put together, because most sellers are not comfortable with that. But when we kind of explain how we mitigate the risk, they understand it, right? But for you guys who would ultimately say you want to buy a turnkey deal or buy a property subject to, it's important you understand the due on sale clause. So the due on sale clause is if the bank were to go check all the foreclosure. So it's like we're talking probably at least 90 days in Wyoming to where they can do it. But at the end of the day, if the lender's being paid and they're getting paid every month, like why would they want to do that, right? Why would they want to go foreclose on somebody? That said, there are some lenders that will, like WCDA loans. I know those guys will not put up with, And evidently they have people that are like checking and doing title searches. The biggest thing is, as long as they keep getting payments, they're never really gonna know, right? Unless you miss a payment. The only other way that sometimes gets triggered, and it's a tricky one, is insurance, right? So if you go change the insurance, or there's some changes in insurance, that can sometimes trigger them to be like, oh wait, what happened? And then they go to the county records and they see that the deed changed. So that's one way you gotta be a little bit careful. What we do is we leave the current insurance in place with the seller, and we add ourselves as additional insured. That way we don't have to mess with it. But there's still always a risk, right? But let's say that the worst happens and the lender finds out and they're like, we're not okay with this. Again, I don't think many lenders want to do this because they don't want to foreclose and they're not in the business of owning property. But let's just say they want to be difficult because you know what? They are unhappy that they've got a mortgage on their books at 3% and they'd rather renegotiate it at 10 or something, or 8 or 9, right? That could happen. So in those situations, what we can do is you can actually, and you could write this into your front end contract. We typically don't because we don't want to convolute it. But what you would do in that situation is you could deed it back to them. So say, okay, lender, we're going to unwind this. We're going to deed the property back to them. That way you're protected, everybody's good. And you could then set up a lease to own or rent to own agreement with the same terms, right? Because there's nothing wrong with a lease to own, right? The only difference is in a lease to own or a rent to own, they're on the deed, right? And you've got a contract, or go contract for deed is the other big one. You know what, let's undo that. Let's actually go contract for deed. And if you're familiar with that, it's just, yeah, it's the same thing. It's an escrow. But the other big thing that I didn't mention is escrow payments, all right? So often when we set these up and we take over subject to, we'll actually go through an escrow company and I will make my monthly payment to the escrow company. Escrow company makes a payment to the lender. And that makes my front end seller feel a lot better that, hey, I know my payment's gonna be made because I got this escrow company that's gonna take care of it. And if you don't make your payment, they're gonna tell me, right? And that also is a good way because the lender's not gonna know because payment is coming from this escrow company, which lenders get paid by escrow companies all the time, right? So payment's coming from them and it makes people feel a lot better. Exactly. Yep. Any other questions on the due on sale and that mitigation? Again, it is still a risk. And then what we always say we end up selling this to the in-person. The other worst case is you just have to go refinance, which nobody wants to do right now at current rates, but it could be done. You could also just buy it out and just pay it off with cash, which again, most people probably don't want to do, but if that's the worst case scenario, it can still be done. Yeah, exactly. And the thing is, again, and it's not like, oh shit, I got 2 weeks and the bank's foreclosing on me. It's like, no, they're gonna, if the bank actually wants to do it, they're gonna have to go all the way through the foreclosure process. I mean, that's why they're gonna work with you, right? And that's why you go back to them and say, okay, hey lender, so I understand you're unhappy with this. This is the way it's set up. Like, how do we fix this going forward? And how, you know what I mean? Work together. What's that?
It's like, what type of bourbon do you like?
Yeah, exactly. Try to think what other questions you guys have on like the logistics of how these creative finance deals work. The big one I wanted to talk was the due on sale clause. One thing is sometimes I've been careful about my language. I always talk subject to. We used to say assuming the loan, but again, you could also go, if it's like VA loans are assumable, you can actually go through the process and go through the VA and say, hey, I want to assume this loan. I haven't actually done it and gone through the process yet, just because I didn't want to jump through all the hoops. And then also I was a little fearful that they would try to renegotiate the rate.
They will, unless you're a VA once you're a VA and you do a VA loan, you can continue to do VA loan on your next property. So if you're not being a veteran, unless you're a veteran,
yeah,
you're not going to be able to assume that loan. So that 2% or 3% that they have is gone.
It's gone, yep.
Yeah, I can imagine paperwork for that.
Yeah, exactly. So that's why we've elected, but there are options where you can just assume it if you work it out with the lender. And people do that. This is just the cleaner, this is the faster, easier way. The other thing is that's nice when we're working with these sellers that they're just like, it's easy for them. Like, hey, I don't need to go get an appraisal. Like I'm not gonna have, it's just way cheaper. We cut out so many fees. That's the other cool thing about the Revive method where I told you we're flipping it, is we're not having to pay for 2 closings. We're not having to pay like double agent fees. We basically just pay our agent on the back end to go list it and get it flipped for us. And we'll go make all the repairs in the meantime. The deed will change, right? But it just saves so much more money that we don't have to go pay, again, lender fees, financing fees, title fees.
To take those properties on and keep them in your portfolio as rental properties for a shorter term, say 5 years, in my opinion, is a better way to look at it because the market's going to change. Interest rates are going to drop. You can get in now. You've limited your risk to a 5-year plan on that property. And rentals are great. They're golden right now.
Yep. You're right, JR. That's the beauty of this strategy, is like the rental market is as good as it's ever been.
It is.
And that's why some of these deals are working, because these people don't want to be landlords. They got to move for whatever reason, and they don't have a whole lot of equity. So they're like, yeah, heck yeah, give me $5,000, Casey, and get me out of here and take over my mortgage. And then this is great for us. I'm like, okay, cool. I'll take your payment and we'll rent it, because we've got a team and a system that does it. What other questions? Clint, was there any other ones like that you could think of that I wanted to talk through on the frequently asked questions? I'm trying to think of some of the other ones I get. Oh, that was another big one. So talking about the difference between a mortgage and going like contract for deed, right? So when we go to sell these, we'll sell them a couple different ways. So let's say that again, Tyler or JR wants to buy this property. My preference to do it is because I've made a commitment to that seller that I'm gonna make his mortgage payment, right? But now ultimately I wanna sell these deals to you guys so you could take advantage. I'll make a little bit of money on the front end, which helps my business and my marketing and my team and my overhead, right? So I wanna sell it to you guys, but I'm gonna sell you my terms. So you could do it a couple different ways. We could do it as a contract for deed, and we could do it as just an outright sale with a mortgage. So let's explain the difference. My preference is to do contract for deed. And the reason is I've committed to that seller, I'm gonna make his loan payment, right? And again, I would know you guys and trust you that Tyler's gonna make his payments, right? But what if something happens to Tyler and Tyler stops making the payments on this house? I set it up as a contract for deed between me and you. That way, if something happens to you and you don't make your payments, the contract for deed is set up, you forfeit your down payment essentially, and I'm able to take back over. And that way, again, I'm doing it to protect my seller because I've committed to those guys, hey, I'm not gonna flake on you, right? But the other way we've also done it is, and this isn't as good for me, but again, I've been flexible with some people, is I sell it to you and actually change the deed. So then the deed goes to you, and then we have a mortgage for the amount that is owed. Like, cause a lot of times these deals, as I showed you, there's like a balloon payment in 5 years that is gonna be due. Cause okay, we're thinking about how we're stacking this deal up, right? Like in the situation where I told you one of them, the guy owed 150, but we gave him a second lien on his equity for 50K. What I would do is I would make you sign a mortgage, and we would file that at the county that, okay, deed transfers to you, but you gotta pay this mortgage. I mean, you gotta agree to this mortgage. So whenever you go to either, like JR said, you refinance in a couple years when rates are back down, or you sell the property, when you do that, you have to pay off the subject to mortgage with the bank, then you pay them back their equity. But the difference is the deed's in your name and there's a mortgage filed at the county, right? So that's one strategy to recap it. But the other strategy is we don't actually transfer the deed, we put it into a contract for deed, which is held by an escrow company. You actually sign 2 different deeds. I'm getting in the weeds here a little bit, but basically in that situation, I sign a deed to give you the property, but I don't actually release it. We give it to the escrow company, and then you sign a deed back to me just in case you default. And basically he holds the 2 different deeds, and as long as we follow the contract, you pay it off, then he gives you the deed and files it. If you default, I get the quitclaim deed, which technically the deed never changed, but that makes it clear title that now it's my property, right? But the deed never gets filed, and that's also helpful with the lender, right? In that situation, sometimes we'll do it because the deed hasn't actually changed, so the lender doesn't have to worry about. Yeah, bingo, yep. And you just go through an escrow company and all the payments run through them. So 2 different ways to kind of structure it with the end buyer. Or you could go rent to own. That's kind of the third one that I actually did with that guy in Chicago, because we thought it was just gonna be cleaner and easier if basically he had an option to rent to own, and whenever he decides to pay it off. And I mean, it's kind of nice for him because he's just getting a check every month and I'm renting it out for him. So he's kind of like, yeah, let's just do that and not do because there is definitely a decent amount of paperwork for when you set up a contract for deed. It's definitely doable, but it takes a little bit of time. Any other questions? What do you think on it? Is it too creative, JR?
No, I'm just curious how you got Mark Smith. Remember I called you about Mark Smith and I gave him your number stuff. Then you listed it with Donna.
Yeah.
I had just a short listing on that thing.
Yeah, it wouldn't move. And then, yeah, so I called him initially as soon as he told me. I talked to him. We kind of talked about the deal, and he didn't want to do it. Because again, I told him like, dude, there's no way I can either pay you a big discount, which he didn't want to take based on the condition of the house, or I was like, or we can do this creative finance, and he didn't want to do either, but then he ended up listing it and it sat for several months. And I was like, Mark, I could still do this. You're not selling it. So he's finally like, yeah. But again, no money changed hands on that one. Like I didn't put any money down. He basically just signed over the deed and I took over his mortgage. And then I'll pay him off in 5 years.
Yeah, and the zoning on that's P2.
Yeah.
So the zoning on that is really good.
Yeah.
I don't know what you put in there, but
I know.
on that back end of that shop garage, but
That's what I'm kind of thinking. Which I like it. But again, I've added it to the list because I'm hoping somebody else is like, yeah, I'll put.
That 3 shop.
Yeah. 3-car garage.
I need to check that out.
Yeah, I'll send it to you. I mean, it needs some work. But I think somebody
So
could.
you said that was the down payment of 20
Yeah.
30, right?
20,000. Yeah, 20,000 down. And then you could go put in some work into it. But it's tricky. I mean, and the only other hard part, JR, is it's hard on these when I'm trying to sell them, because a lot of times, sometimes I'll get them in like, okay, I've got one in Torrington right now, and I've got one in, you remember, or I guess you guys probably didn't play there, in Manderson, right outside of Grable.
Yeah, in the middle, like the
Yeah.
population of 6.
Yeah. So I got this one in Manderson where the freaking payment's like $900, and it's a really nice house, well-built house. But I'm just trying to find, and I'm trying to work with an agent there to go find me a buyer that can't get financing. And I guarantee there's some people that would love to walk into that $900 payment. Same thing in Torrington, where it's a good payment, but I'm trying to work with agents that know the buyers there, but there's not enough cash in it to really pay an agent, which is hard. You know, because that means that's an additional down payment. And typically these buyers that are wanting to buy it they want to buy it because they only have 10,000 down or 20,000, but then you're trying to pay a commission. That's where we're struggling on some of them. Or that same thing happened to that one in Cheyenne, right? Like that guy was going to put down 75K, but I had negotiated with my sellers on the front end and I was giving them like 50K down, and then we were going to take a smaller chunk, but then it's like I was trying to work with an agent. There just wasn't enough. That was, especially at a $700,000 house, that's like a $35,000 commission check. We're like, it's just hard to make it work.
Yeah.
So that's, anyway, so we'll mark it on like Facebook and just other Craigslist and places to try to find the buyers. Or again, the nicer thing, and again, why I did this presentation is want to work with more, that again, I can understand investors not want to do Manderson or Torrington or go buy a 700K house in Cheyenne, but these smaller ones, it's easier to go get an investor behind, hey, like here, look at your cash flow on this and just look at that long term. And the fact that you're only having to put $20,000 or $30,000 down, I'm finding that it's better, there's more investors interested in buying those deals than home buyers. Because a lot of, I don't know, I've just found, maybe not unless in Sheridan, but
It's super easy.
yeah.
And you can offload it in about 4 years. You know, in good circumstances if you build them up.
Yeah.
a lot of those people, if they're in a tight spot in that 3 to 450 price range, they refinance, they got that new truck, that sled, crap.
Yeah.
Just lost their job. I mean, it's an unfortunate situation, but for them to be able to get out of it, like I said, the rental part of it, that's not going to talk myself out of the job. But you're going to want to sell that too.
Yeah, exactly.
Absolutely.
Because the market's going to be strong.
Yep,
Yeah.
exactly. Oh yeah.
Get your write-offs in the next 4 years, 3.5 years, 4 years.
That's the other one I want to do with more people. I want to find more people that in 2023, because again, depreciation, if you guys look at the tax law, right? It dropped to 80% this year, right? Next year, it's going to drop down to 60% on bonus depreciation. So if you look at like cost segregations, you can go write off a big chunk of the rental property. If it's a rental property you're buying, you can write off a significant amount. So this started with Trump. He put this into play where you could get, they call it accelerated depreciation. Instead of going over 27 years, you can do it like in year one. Yeah, exactly. And so then they went and started to get, yeah. So now they've dropped it out though to where it's saging down. So again, the year before last year was 100%. Now it's down to 80% this year. And it's gonna, as soon as January 1st hits, it's down to 60. So I'm trying to work with more investors and people who wanna buy something before the end of the year, buy one of these deals and then go do a cost segregation. And then they can go write off. Like it's sometimes you can write off 20% of the purchase price. It's probably now more like 15 because they've scaled it back, but.
Now your CFC is only 10%.
Yeah, I mean, think about the numbers. You buy a house that's worth $200,000
Yeah.
and you write off 15% of that in year one, that's a $30,000 write-off.
That's insane.
Cool. Any other questions?
No,
Thanks,
that's
guys.
good.
I know you got to run, JR.